My name is Farhan. In today's video, you will learn to prepare the Statement of Financial Performance, which is also known as the income statement, and the Statement of Financial Position, which is also known as the balance sheet. The question that I have here is from a past exam paper. So you can get to see the question on the left-hand side, and on the right-hand side, you will get to see all the workings that I will explain today. With that being said, let's get started. Young runs a hardware store business. The following balances were extracted from the books of the business on 31 December 2022. So you can see that within this table, we are given a list of balances for various items within the business, such as non-current assets, expenses, liabilities, equity, etc. We are also given some additional information here, as you can see from number 1 all the way until number 6, which we need to incorporate in our workings. We are required to prepare the Statement of Financial Performance for the year ended 31 December 2022, and then the Statement of Financial Position as of 31 December 2022. So what I'll do first is show you all the workings on the right-hand side of the screen, which you can get to see. So starting with the first additional information that we are given. Fixtures and fittings are depreciated at 15% per annum using the straight line method. Now, when it comes to the straight line method, we can simply apply the given percentage, which is 15 in this case, multiplied on the original cost. Now, where can you find the original cost of these fixtures and fittings? The original cost is always going to be within the table or the trial balance that will be given to you. As you can see, the very first line, fixtures and fittings at cost of $125,000. This is your basis for calculating the depreciation using the straight line method. So what you can see is that I wrote depreciation per annum for fixtures and fittings, and that can be calculated by multiplying 15% with the original cost of $125,000, and that gives you $18,750. Also, because this is a straight line depreciation, we will have the same depreciation of $18,750 every year, all the way until the end of the asset's useful life. Next, additional information number 2 says the motor vehicle is to be depreciated at 20% per annum using the reducing balance method. Now that we have the reducing balance method, what do we do in this case? The reducing balance method calculates the depreciation by applying the given percentage on the net book value. So how can we find the net book value? Net book value is also known as the carrying amount of the asset. So the net book value can be calculated by taking the original cost and subtracting the total depreciation, which is also known as accumulated depreciation. So where do we get the figure for the total cost for motor vehicles? It is right in the second line within the table, motor vehicles at cost of $30,000. So that is the cost we are using here, $30,000. What about the total depreciation or the accumulated depreciation? You can see we are given the accumulated depreciation for motor vehicles to be $6,000. Accumulated depreciation simply means the total depreciation for the motor vehicles since the very first day it was purchased, and that is $6,000. So how do we find the net book value or the carrying amount now? 30,000 minus 6,000, which gives us $24,000. Now, we apply the given percentage of 20 on the $24,000, and that is the difference of the reducing balance basis with that of the straight line method, where we use the cost instead. So 20% multiplied on the net book value or carrying amount of $24,000 gives us $4,800. Now, before we move to additional information number 3, I want to make sure that you understand the meaning of net book value. Net book value or carrying amount simply refers to the value that is remaining within the non-current assets to be utilized in the business, which helps the business generate more revenue. Okay, so net book value simply refers to the value that is stored or remaining within that non-current asset for usage within the business in the future, and that will generate an economic benefit and a revenue for the business, which is also known as sales. So let's move on to additional information number 3. The allowance for impairment of trade receivables is to be maintained at 4% of trade receivables. Now, impairment here refers to the possibility that the trade receivables, who are the credit customers of the business, are unable to pay the business back. Now, how do we calculate the allowance for impairment of trade receivables? The question explicitly mentions to apply 4% on the trade receivables. So the trade receivables, who are known as the credit customers, you can find within this balance, within this table that's given to us, and that is $38,400. So what we do is simply multiply 4% on 38,400, and that gives us $1,536 as the allowance for impairment of trade receivables. Now, I also want you to notice something else. You can see that there was a balance for allowance for impairment of trade receivables, and that is $2,200. And this is from the beginning of the year or from the end of the previous financial year, 31 December 2021. So compared to that $2,200, today we are estimating at 4%, which gives us an allowance for impairment of $1,536. So as you can see, this number has decreased significantly from $2,200 from the previous year to $1,536 at the end of the current year. This decrease, the difference is $664. So is this a good thing or a bad thing for the business? So we need to understand that allowance for impairment simply refers to the business putting some money aside for the fact that they expect that there is a possibility that this amount of customers will not be able to pay back their obligations to the business. Now, the previous financial year, we had a higher possibility of more money that we won't be able to recover, and that was $2,200. But this year, it is $1,536, so it has gone down. So if it is going down, it signals a good thing for the business. So what do we do in that case? We classify this as a reduction in the expenses compared to the previous year, and that is what we also call the decrease in allowance for impairment of trade receivables, or the reversal for allowance of impairment for trade receivables. And that is $664, and the business is now in a better position compared to the previous year in terms of the debts that they could collect from their trade receivables. Okay, so let's move to point number 4. So additional information number 4 says wages and salaries of $2,800 were owing and insurance expense of $1,500 was prepaid. So wages and salaries owing of $2,800 refers to the current liability that the business has at the moment. The reason this is a current liability is because the business has used the service from the staff or the employees, but they haven't paid their employees yet, and that amount is $2,800. So this is an obligation for the business. This is an obligation for Young, who runs the business. So what's happening in this case is this will be shown as a current liability when you prepare the statement of financial position. Now, at the same time, in the income statement or the statement of financial performance, you need to include the expense total for wages and salaries. And how much is that? So if you check the balances that we are given, you can see that wages and salaries are given at $31,000, which is the expense that we have incurred so far. But the additional information requires us to adjust an additional $2,800, which is a current liability that hasn't been paid yet. So therefore, the total wages and salaries expense we must report in the statement of financial performance or the income statement is $31,000 plus $2,800, and that is $33,800. Okay, so just to do a quick recap, $2,800 of wages and salaries owing will be shown within the current liabilities section of the statement of financial position, and the total wages and salaries expense of $33,800 will be shown in the statement of financial performance, which is also known as the income statement. Next, within this question, we are also given insurance expense of $1,500 was prepaid. Now, what does that mean? So prepaid insurance expense simply refers to Young paying for insurance in advance, which means, let's just say for the next financial year, 2023, Young has paid insurance, and this insurance is a current asset to Young. Why is this a current asset? Because this is paid in advance, or this has been prepaid. Young hasn't consumed the benefits that comes with this prepaid insurance yet. Young will expense this insurance in the next financial year. Therefore, to Young, this holds a significant amount of current asset for the business. And because this is a current asset, you must include this in the statement of financial position under the current assets section of $1,500. Now, how much should we show in the statement of financial performance or the income statement? So let's check the table that we're given here. You can see the total amount for insurance that is shown here is 8,500. So within this 8,500, we know 1,500 has been included, which refers to prepaid insurance. Therefore, the actual expense that the business has incurred for insurance for the financial year ending 31 December 2022 should be 8,500, that is given in the table, minus $1,500, which is paid for next year and therefore is not valid for this year. And that is $7,000. Now, I also want to ask you another question. Which accounting concept are we referring to in this case? Which accounting theory are we referring to in this case? It's the accrual concept, the accrual basis assumption, which simply talks about finding the profit or the net profit by subtracting the expenses that we incurred or actually consumed in this financial year from the revenues that we have actually earned or that we actually delivered the service or the product for. So what's happening in this case? The prepaid insurance of 1,500 is paid in advance, but it hasn't been consumed or incurred in this current financial year ending 31 December 2022. And that is the reason we classified that portion of $1,500 as a current asset, and we only show $7,000 as an expense in the statement of financial performance. So let's move on to additional information number 5. The bank loan was obtained at 1st of January 2022. Interest on the bank loan for the year to 31 December 2022 had not yet been paid. So what we can understand is that at the very beginning of the year, Young took a loan from the bank. And that loan, if you check the table that's given to us, you can see the amount for the bank loan was $25,000. So that is how much Young has borrowed. Now, we also understand that we are obligated to pay interest on this bank loan. And what is the interest rate? It's 5%. So the rate that we have here in this case is the annualized rate, which is the rate for per annum basis for one whole year. So whatever interest that we will be paying on this loan for the whole 12 months, for the period starting 1 January 2022 and ending 31st of December 2022 is 5% multiplied on the original loan amount of $25,000, and that gives us $1,250 as the interest expense for the period. Now, the question clearly mentions that the interest has not yet been paid, which means this interest is owing by Young. This interest is a liability. This interest is known as an accrued interest expense or interest expense owed. And we must show this 1,250 as a current liability in the statement of financial position, and also the 1,250 as an expense that has been incurred for the financial year ending 31 December 2022 in the statement of financial performance, which is the income statement. Okay, so as you can see, we got two separate things to do for the interest as well. One that's going to the current liability and one that is shown as an expense in the statement of financial performance. Now let's go to additional information number 6. Now, additional information number 6 says a repayment of $5,000 on the 5% bank loan is to be made during the year ended 31 December 2023. All right. So what's happening in this case is that we are paying off $5,000 from the amount that we borrowed. So by we, I mean Young. So Young borrowed $25,000 and Young wants to pay $5,000, but that's going to be in the year ended 31 December 2023. So that is in the next financial year, right? Why? Because we are concerned about doing the statements for 31 December 2022, which is the end of the current financial year. But Young is more talking about $5,000 to be repaying in the next financial year, right? So here is something that you need to understand. So the bank loan we understand in total it is $25,000, which is $5,000 that we are going to be paying in 31 December 2023 and $20,000 which we will be paying from year 2024 onwards. Now, the 5,000 that we will be paying in the next 12 months, given that today we are at 31 December 2022, is defined as a current liability. Current liability refers to obligations or liabilities that the business needs to repay within the next 12 months. So this $5,000 in loan repayment is a short-term thing for young. So therefore, this $5,000 needs to be classified as a current liability in the statement of financial position. And the other $20,000 that will be remaining from the loan can be paid off in the years 2024, 2025, 2026, which is not in the next 12 months, but after the next 12 months. And therefore, this $20,000 fits the definition of a non-current liability and needs to be shown separately as a non-current liability if you want to get full marks in the main exam. Now let's prepare the statement of financial performance or the income statement for the year ended 31 December 2022. So we're going to start with sales revenue to begin with. So I've done the format already here in advance. So let's just first start with the sales revenue and sales returns. So let's go back to the question, and you can see the sales revenue is given as 232,500 and sales returns is given as 14,950. Now I have a question for you before we go ahead. So if we had a trial balance, how do you think the sales revenue and the sales returns would have been recorded, given that in a trial balance we have one column for debit and one column for credit? Sales revenue by default is always a credit account. So you would look for on the credit side to find the relevant value for sales revenue. And sales returns, which is basically reducing your sales, would need to be debited, which is what you would always find in the debit column of the trial balance. So if you get a question where you're given a trial balance instead, and you're supposed to use the trial balance as your basis for preparing the financial statements, then for the sales revenue, look for that number on the credit side, and for the sales returns, look for that number on the debit side. So we got sales revenue of 232,500, sales returns of 14,950. So what I'd like to do to make sure that I haven't missed anything, which is what I suggest you do during exams as well, highlight the numbers that you have already used within your preparation of financial statements. So that way you can already know that if you have missed any important information. So let's go back to the page where we have prepared everything for the sales revenue. So sales revenue is what we figured out as 232,500, and sales returns is 14,950. So what do? So we subtract sales returns from sales revenue, as you can see, based on the format we are using, which says sales revenue less sales returns gives us net sales revenue. So that should be 217,550. Okay. Then we have the cost of goods sold. So let's go back to the question. So the cost of goods sold is what you can see here, given as 123,200. So which is what we are just going to include here simply. And we are going to keep that within brackets. This is because we are subtracting the cost of goods sold. So once you subtract the cost of goods sold from the net sales revenue, you get the gross profit, which is 94,350. Then we're adding any other income. So you have to look for any other income that we have been given within this balances. Now, other income, what type of other incomes can we generally get in exams? We can get the gain on sale for non-current assets, and you could also look for discount received, which is also an income. What does discount received refer to? Discount received refers to the amount that you received as a discount from the suppliers when you wanted to pay your bills that you owe to your supplier. So the suppliers here are who I refer to as the trade payables of the business. So when you pay off your trade payables, they give you this discount for prompt payment, and that is what we call the discount received, which is also known as the other income, and that could also be included as part of the other income when you prepare the statement of financial performance or the income statement. So where do we look for this too? If you scan through everything, you can see we do not really have any discount received, but we do have gain on sale of non-current assets, and that is 3,600. So let me just quickly highlight this to reflect the fact that we have already utilized it. So let's go back to the outline that we already had prepared in advance. So other income, I'm going to include gain on sale of 3,600. That's it. That's it for the trading portion of the statement of financial performance. So the trading portion refers to the portion where you stop at gross profit plus other income. Now, we include the expenses portion, which is less expenses as you can see here. So again, I have outlined all the expenses that we are going to be using. And here, in most cases, you have to reflect all the workings that you have done in the additional information. Starting with wages and salaries. How much should we include for wages and salaries? If you recall from additional information number 4, total wages and salaries expense that we wanted to include in the income statement is 33,800, right? 2,800 is what we need to show separately in the balance sheet or the statement of financial position as a current liability. So in this case, we are going to show 33,800 as the total expense that the business has incurred or consumed during the financial period ending 31 December 2022. Now, I have another question for you. Which accounting theory and concept are we applying here? Accrual basis, which simply mentions that if you want to find profit, you start with revenues that you have actually earned minus the expenses that you have incurred or consumed during the financial year. And in that case, $2,800, the amount that we were owing, is also an expense that we consumed and must be added to 31,000, and therefore gives us the total wages and salaries expense of 33,800. So that is what we are going to include here. Wages and salaries expense of 33,800. All right. Then we also got insurance expense. So insurance expense, if you recall, we had prepaid $1,500, and that is a current asset. The reason we call this a current asset is because we haven't consumed this insurance in the financial year ending 31 December 2022, but we have paid for insurance in advance and we will consume this amount. We will use this insurance the next financial year. Therefore, we have an economic benefit at the moment, and that is why we classify this as a current asset. So the amount for insurance expense we include in the statement of financial performance or the income statement is simply 8,500, which is what you will see is given within the table here. And we subtract the prepaid portion, and that gives us $7,000, which we want to include here for the insurance expense. Now, what I want to do is highlight the insurance expense and the wages and salaries that we have already taken care of. All right. So what's next? You can see we have the rent expense of $12,000, and based on our workings today, we really did not have any adjustments to make for rent expense. So we can just include the $12,000 for rent expense. So rent expense of $12,000 already done. Then we got general expenses and the two types of depreciation. So the depreciation calculations are what we have already done in additional information number 1 and additional information 2. So additional information number 1 calculated the depreciation for fixtures and fittings to be 18,750. So that is what we are going to include here. And additional information number 2 calculated the depreciation for motor vehicles to be 4,800, which is now what we are going to include here. Next, we have to look for general expenses and the reversal of impairment. So general expenses are given to us here. which you can see 9,800. So let's take that amount of 9,800 and we can utilize it here. All right. Now, what is this thing of reversal of impairment? So this reversal of impairment refers to the reduction that we had in the allowance for trade receivables. If you remember, based on our calculations, the allowance for impairment of trade receivables for the year ending 31 December 2022 was 4% applied on the trade receivables that was given in the balances of $38,400, and that is $1,536. But last year, or at the beginning of the year, the allowance for impairment of trade receivables we had was $2,200. So compared to last year, we had seen a reduction, and that reduction is the $664, which is a good thing for the business because it reduces the expenses for the business, or the excuse me, or the likelihood or possibility that the business now can be collecting more in terms of the credit sales that they have made in the past. So $664 is what we are going to include here as the reversal of impairment, and we're going to keep that within brackets because it's a good thing for the business, which refers to a reduction in expenses. All right, so let me just quickly explain this once again. The allowance for impairment of trade receivables was calculated based on the additional information number 3, which asked us to multiply 4% on the amount for trade receivables of $38,400. And that gave us $1,536, as you can see on the working on the right hand side of the screen. And based on the previous year allowance for trade receivables of $2,200, as you can see here, this has decreased in the current financial year ending 31 December 2022, and the amount for the decrease is the difference between 2,200 and 1,536, and that is $664. This reduction is a good thing for the business because it reflects a reduction in expenses. And why is this a good thing? Because the likelihood that we are going to collect all of the money that we have that our trade receivables or the credit customers owe us is now more. So there is a better chance of collecting all the money that we have sold, all the inventory, and all the money that we have, all the money for the inventory that we have sold on credit. So because now it's 1536, there's a reduction that reflects 664 decrease, and which is a good thing, and that is the main reason behind why we are subtracting this here, just to reflect the fact that there's a reduction in the expenses compared to the previous year impairment of trade receivables. Now, let's see what else do we have. So we have the interest expense, if you recall, from additional information number 5. So the amount that we have borrowed was $25,000 and the interest rate was 5%. So this interest rate wasn't explicitly mentioned in the additional information number 5, but this is something that we got from the balances that were given to us here, 5% bank loan of $25,000. So that is what we have done here. So we multiplied 5% on $25,000, and that gave us $1,250 as the interest expense. The question also explicitly mentioned this interest on the bank loan had not yet been paid, which means what we are doing in this case is showing this as a current liability, which refers to interest expense accrued or interest expense owing or interest expense payable. So they're the same things anyway. So we also classify this as an expense in the statement of financial performance. So this is to be recorded in 2 different places. One, the statement of financial position as a current liability, which is known as interest payable, and as an expense, which is known as interest expense in the statement of financial performance or the income statement. So let's go back to the outline we have created and fill in with $1,250 for interest expense. So we got all of the expenses sorted in place. And if you quickly scan through the balances that we're given, we sort of used everything. We used these first 4 or 5 lines regarding non-current assets as part of our depreciation calculations. And then we got inventory and all this stuff that we will be showing in the statement of financial position eventually. So now we can find the profit, but before we find the profit, we find the total of all expenses. So you add everything here together with everything that is given here, and that should give you 86,736 as the total expenses. And once you subtract the total expense of 86,736 from the gross profit and the total of other income of 3600, you should get 11,214. So just do it with me quickly and check you get 11,214. So what do we do first? We take the gross profit of 94,350, and then we add the other income, which is the gain on sale of non-current assets of 3,600. Not sure if you can see clearly though. Okay. And then you subtract the total expenses, and that is 86,736. So let me just quickly type that in so you can see. So it should give you something like, okay, I have put the minus 2 times, and I apologize. So it should give you something like $11,214 as the profit for the year. All right. So we started with the gross profit of 94,350 plus the other income of 3,600 minus the expense of 86,736, and that gives us 11,214 as the profit for the year. Okay, so that takes care of the statement of financial performance fully. Now we're going to look into the statement of financial position, which is also known as the balance sheet, and that is as at 31 December 2022. So I've already created the outline for you in advance. So you see how we start with non-current assets. So the two types of non-current assets that we have are fixtures and fittings and the motor vehicle. So let's just quickly start with that. So I'm just going to write fixtures and fittings plus fittings. You can write and fittings. I'm just going to quickly do the walking for you, and then the motor vehicles. Now, where can we get to find the cost for fixtures and fittings and motor vehicles? Obviously, look into the balances that are given to us. Fixtures and fittings that cost 125,000, motor vehicles that cost 30,000. So let's just include these two numbers here first. Then we need the accumulated depreciation for either types of assets, which is also known as the total depreciation. So how do we find the total depreciation for fixtures and fittings and motor vehicles? You can see the accumulated depreciation that we were given for previous years. For fixtures and fittings, it's 37,500 plus an additional 18,750 for the financial year ending 31 December 2022. So 18,750 plus 37,500 should give you the accumulated depreciation for fixtures and fittings. And if you get 56,250, you are correct. So 56,250. So let me just quickly write that here. Now let's repeat the same thing for motor vehicles. So for motor vehicles, the accumulated depreciation or the total depreciation for previous years of usage is $6,000. And that added with the depreciation that we calculated for this year of 4,800 gives us a total of $10,800. So $10,800 is what we need to include here for motor vehicles, and that takes care of the accumulated depreciation for fixtures and fittings and motor vehicles. So how do we find the net book value? If you recall from our previous steps based on additional information number 2, where we used the reducing balance method, we found the net book value to be the difference between the original cost and the total depreciation. So what you just do simply is subtract the total depreciation from the original cost. So if you do it for fixtures and fittings, you should get 68,750, and for motor vehicles, you should get 19,200. So what I need you to do afterwards is find the total, which is 87,950, because this total is eventually what you will be using for finalizing the whole balance sheet. So $87,950 is the total for the net book value of the two types of non-current assets of fixtures and fittings and motor vehicles. All right, so now we have to take care of current assets. So current assets refer to those assets which can be converted into cash within the next 12 months. And for example, those could be your trade receivables. Those are the people to whom the business sells goods on credit. And these people are now an asset to the business, and the business expects to recover the money from this trade receivables in the next 12 months. And that is why we call them a current asset, because we want to collect them in the next 12 months. Who else? Oh, sorry, what else do we have? So you could think of prepaid insurance of 1,500 if you remember that we have paid because we haven't consumed the benefits yet, which we'll be consuming in the next financial year. Also, you could think about cash or any funds in the bank account, stuff like that. So let's go to the balances that we are given. So I'll just highlight everything that we have utilized. So as you can see, we have already taken care of a lot of the information. So the first one we have here is inventory, and that is 47,400. So why is inventory a current asset? So inventory is a current asset because we could sell this inventory to our customers in the next financial year, and we would be able to convert this inventory into cash, which is a good thing for the business because the business does not really want to have a lot of inventory because this inventory will become old, they will become obsolete, and the business will lose money. So that is why we classify inventory as a current asset because we want to get rid of this inventory as quickly as possible and definitely within the next 12 months in the next financial year. And that is why we call inventory a current asset. So inventory is 47,400 that we have to include here. Let's just include here in the first column, the second column. I don't think it really matters, so don't worry about it. So second column, inventory is 47,400. So let's highlight that. Then we got the trade payables, which is not a current asset, but a current liability. So why are trade payables a current liability? This is because these are the obligations. These are the credit suppliers from whom the business purchased inventory on credit with a promise to pay back. So this is what we classify as a current liability because we have to pay them within the next 12 months. So let us just quickly include this number in the current liability section of $24,000 for trade payables. So trade payables of $24,000. Okay. Next, we got the cash at bank, and that is a debit balance, which refers to a current asset. So a debit balance here refers to the fact that the business has some money in the bank account, and that is $2,300. If this was not a debit balance, but a credit balance, that is what we would be classifying as a current liability, which is known as a bank overdraft, which is an obligation for the business. In this case, we have a debit balance, so it's safe to say we got some cash, and that is a current asset. So $2,300 are what we are going to be including in the statement of financial position. So cash at bank, $2,300. All right, so cash at bank, $2,300 taken care of. All right, so do you believe we have used all the current assets? Let's see. I think we haven't used trade receivables and the allowance for impairment. And the reason being because we already highlighted it before when we found the allowance. We shouldn't have done it, but it's okay. So trade receivables of 38,400. However, we also need to subtract the allowance for this year. So let me show you how you're going to include this. So I don't have sufficient space here, but let me just remove something for you, please. Okay, so I'll make some space here so that I can write on top. I apologize for that. So we start with trade receivables. So I'm just going to write trade rec in short. Make sure to write the full word in the exam. So trade receivables is 38,400, and we subtract the allowance. Make sure to write allowance for impairment of trade receivables, the entire thing. I'm just writing allowance because of the lack of space that I have. So from 38,400, we subtract the allowance of 1,536, not 664. 664 is what we have shown in the statement of financial performance. So make sure to include 1536 because this is the allowance at the end of 31 December 2022. So 1536. So when you subtract 1536 from 38,400, the net trade receivables is 36,864. And then the other thing to include is the prepaid insurance of 1,500. So let's include that. Prepaid insurance of 1,500 is also included. So now we do not really have any more current assets. So what we can do in this case is find the total of the current assets. So what's the total of the current assets? You add everything in the second column. All right, so add everything in the second column. So we start with 47,400 and then add 2,300 and then add 36,864 and then add 1,500. So that should give you 88,064. So 88,064 as the total current assets. Just take it to the third column, because the third column is basically the final totals that we will be adding eventually. So now what I want you to do is add the total of non-current assets with the total of current assets. Add 87,950 with 88,064. So let's just do that. So total assets will be 176,014. All right. So total assets are 176,014, and that was calculated by adding 87,950 with 88,064, which are the totals for non-current assets and current assets respectively. So now that we have the total assets, the next thing that we need to do is the equity and liabilities section. All right, so for the equity, we are simply referring to the closing capital that the business should have. And how can we calculate this amount? All right, so this is something that we would be doing in the statement of changes in equity for a company that we would be, if we were to prepare that. But using a similar logic, so we start with the opening capital, and then we add the profit for the year. If you had a loss, you would be subtracting it, because any loss that you have basically reduces your equity. And any profit that you have increases your equity. And that is why we are adding it. So opening capital plus profit minus drawings plus additional capital. So all this should give you the closing capital. So it's as simple as that. And this formula is more relevant for a sole trader business, which is what we are working with in this case, because the question clearly says Young. And it's not really a company, it's just Young who runs a hardware store business. Okay, so we start with the opening capital. So the opening capital is what is given here. As you can see, it explicitly and clearly mentions capital at 1 January 2022 to be 133,750. So what I'll do is I'll just replace everything with the relevant numbers that we have. Okay, so opening capital is 133,750. Then we add profit with that amount, and the profit we calculated was 11,240, which is what I'm highlighting in yellow at the moment. So 11,214, and then you subtract drawings. So drawings refers to the fact that if you're making a profit, you're withdrawing some of the profits, and you being a sole trader, you want to enjoy that profit because you have earned that profit yourself. So the drawings is 22,000, as you can see. So I'm highlighting that, which refers to the fact that I've already utilized this number. So drawings is minus 22,000. So drawings refers to a reduction in owner's equity. And there are some things I want to also talk about. If you have capital by default, is it credited or debited? capital is always credited. Capital is always credited. Any income is always credited. So when we have profit, that is credit by default. So that is why when we are adding profit to capital, we're actually increasing the owner's capital, or the more capital is going up. But when we have drawings, we are reducing the capital. That is why we are subtracting here. So that reduction refers to a decrease in the capital that we have for reinvestment purposes in the business for the next financial year. We do not have any additional capital in this question, so we don't see Young injecting any more funds or financing into the business. So we only have opening capital, and we add profit, and then we subtract drawings. So what we are getting when we do that is take 133,750 plus 11,214, as you can see here, minus 22,000, and that should give you 122,964 as the capital. Okay, so this capital, closing capital, is what we show here, 122,964. And why are we showing this in the third column? Because this is the final total that we will be eventually adding for comparison purposes and making sure that the balance sheet matches. Okay, next we got non-current liabilities. So non-current liabilities, if you recall, the bank loan that we had a discussion about for additional information number 6, what did we say? So we say 5,000, which we are repaying in 2023, is what we define as a current liability, because this obligation is taken care of in the next 12 months. The remaining 20,000, which we will be paying in other years, such as 2024, 2025, 2026, 2027. You are in 2022. So what happens after 2023 is basically a non-current liability, because they're not due in the next 12 months for payment. So that is why the other 20,000 is what we classify as a non-current liability. And that is what we are going to show here. Long-term borrowings. I'm just writing long-term debt because of the lack of space. Write long-term borrowings, long-term debt, bank loan, doesn't really matter. So, and that is 20,000. And I'm showing it in the last column because there are no other non-current liabilities. Okay. So next, we have the current liabilities. So we already took care of the trade payables, and that is 24,000. So what we're going to do now is include the rest of them, starting with the wages and salaries that we were owing. That is 2,800. So let's just simply say wages and salaries payable, owing, accrued, they're the same thing. I'm just writing wages payable in short because of the lack of space. Then we had interest expense. So this is the main reason behind why you want to do all the workings first and classify what is exactly going to the balance sheet and what is actually going to the statement of financial performance or the income statement. If you remember, interest expense of 1,250 was not paid at all, and that defines it to be a current liability. Okay. And then you also have the current liability portion for the bank loan, which is 5,000. So you can write short-term loan, or you can write current liability portion of the bank loan. I don't have enough space, but I'm just going to write it anyway. So current portion of bank loan, and that is 5,000. It's a current liability because we're paying it in the next 12 months. And then after these 4 current liabilities, we do not really have anything else. So let's find the total for the current liabilities. So you add 24,000 with 2,800 with 1,250 and 5,000, and you should get 33,050, 33,050, same thing. Okay. All right. So the last line requires us to calculate the total equity and liabilities. So how do we find the total equity and liabilities? You add 20,000, which is the non-current liability, with 122,964, which is the capital, with 33,050, which is the current liability. So let me do it. 33,050 is the total for current liability, plus 20,000 is the total for non-current liability, plus the closing capital of 122,964 that we had calculated, and that gives me 176,014. So 176,014. So 176,14, I'm just going to write that here. You can see it on screen. And let's see if it matches. So total equity and liabilities 176,014, and the total assets is 176,014 as well, which means our math is correct and the balance sheet is fully done, which is okay. Now, what equation are we really applying here? Which is basically the fundamentals of accounting, which simply means the total of assets in a business must be equal to the total of equity plus liabilities. So this is the main equation that we're following. Okay, if I was to rephrase this in a sentence, that simply means that all the assets in the business can be financed with equity and with liability. Again, if I was to rephrase this in another way, all the assets in the business can be financed with the money that actually belongs to you and the liabilities, which are what you're borrowing as debt. Okay, so that's basically it for today's session. I believe you enjoyed this content and found a lot of value. Make sure to subscribe to this channel and like this video. And if you need me to cover any more topics, please post them down in the comments below. I'll see you in the next video.